Very pleased to have with us today Ronald Redfield, Managing Partner of Redfield at Blonsky and Company. Welcome.
Thank you.
Great
to be here.
Have you on the program. Look forward to our conversation on value investing and the investment process behind it. Before we get into discussing some topics in value investing, tell us a bit about your path as an investor. What were some people or events that influenced your thinking?
Sure. I started, I am a CPA and keep up with that. I was specializing in business valuation in my younger days. I always loved investing. So, and then I read Benjamin Graham's Intelligent Investor and then Security Analysis, and I became hooked to value investing. From there, I weaned away from traditional CPA and became a portfolio manager. So just reading and understanding as a CPA, security analysis and really being able to absorb that and then to take that to valuing a company, incorporating it the ways we did it as a CPA, it was just a very interesting process. My clients enjoyed using us and the approach, and that's how it developed.
And give us a sense of what perhaps is you found to be challenging in applying the theory in practice and sort of being successful at investing. What are the biggest challenges and how have you improved your process over time, perhaps?
Sure. I've been doing this since 1992, a long time. And it amazes me, I'm 54 years old, it amazes me that I continue to learn. The thing I'm learning most as I get older, and the most in the last year or so, is I like to hold things forever. And selling always just, it seems when something gets sold, it just seems, it almost seems better to hold it for a long period. Not for the sake of holding it, but as you learn an investment or as you're working with a company, you really learn all the cycles of that company, the ups, the downs, the recessions, the negative things, the positive things. And that has been a very interesting thing to grasp. Yet, 2 weeks ago, we sold a position that I've held since 2004. It was a very difficult sale, but I just had to do it. We'll see. Time will tell if it was a good move or not. And it's very possible if the price reduced by 30-50% that we'd once again own that company for an extended period. It was more of the reason we sold it was more of just felt the valuation got a little too high for our comfort zone and better deployed in other positions.
And let's talk about then the various forms that value investing takes. There is the deep value end of it. There is the investing in great businesses along the lines of Warren Buffett in his later stages in life now. And how do you think about just your edge in investing and kind of how you've adjusted your process to be able to take advantage of your insights and edge versus others?
Warren Buffett, a great mentor of mine. I've studied him for years. I've read everything I could on him. It's very interesting how he evolved from a pure Graham person. Then once Munger introduced him to opening up his eyes, and I guess in a way, I've been somewhat similar. I do keep a keen eye on the fundamentals and making sure that the valuation is not out of sync. Granted, we could value a company at 100, and who's to say it's not worth 75 or not worth 125? So we're definitely a big range that would stop us from selling or stop us from selling if it hit a so-called target price. We don't really use that, but So how I've evolved is I've learned to do my best, keep my emotions out of investing, try to just look at it in a very wide picture, to see the forest, not just the trees, and to try to take advantage of various things that cause various emotional things that will cause a company maybe to drop in price for the wrong reasons, perhaps, and vice versa. It might increase in price for the wrong reasons.
And let's maybe, if I can jump in here and just ask you, what are some of these reasons for companies to become mispriced, and what are perhaps some of the situations that over time you've come to appreciate more as opportunities versus others, and have you developed any ways of pattern recognition, and give us a sense of what are just some situations that you get attracted to?
Sure. I wouldn't say that pattern recognition is something that I'm keenly attuned to. I do try to recognize bias within myself, try not to fool myself, because that's a human trait, and do your best to avoid it. One example of we owned a company, a life insurance company that's been around since 1956, 40% owned by one family. When the financial crisis hit, their price, I think, might have taken a 50% plus haircut. That's when I became interested in it. Looked at it. I looked at the quality of their investments. Seemed like a good company. They had a history of being conservative on their financial statements, on their reportings. I spoke to their CFO. We had them get us the annual reports going back to, they couldn't get it before 1970. Well, that worked for us. I read a lot of annual reports. And I felt comfortable that we were going into an investment, not necessarily, no catalyst involved, but an investment that I thought over time Wall Street would recognize as a company that should not be selling at 30 cents on their net asset value, on their net assets. And their net assets were basically conservative fixed income, shorter duration, and they were unlike many other insurance companies. And this is, I think, where my accounting knowledge is very valuable. They were reporting and report most of their investments at cost, amortized cost, as opposed to fair value. So you really saw a discount to net asset value, not only reported, but as to fair value as well. So we started with a small position. It's a small cap company, very hard to accumulate. And we bought it at 160, 150, 140, and it actually went to, I think we bought it as low as 127-ish or something, and really accumulated a large position. And since then, it's gone up quite a bit, and now we've brought it down to a more a position that's not terribly overweight, but it's still our third largest company that we own. So I think the edge there was to be able to find a value in a company and basically take advantage of what Wall Street was saying. Well, Wall Street didn't appreciate the company because they pay a very small dividend. Well, their reason for paying a small dividend was they want a fortress balance sheet. So all their reasonings that Wall Street hated it, we were fine with it because I didn't mind waiting a long period of time for value to show up. I don't need to be reminded what value is if I can basically interpret it. I think that's so we basically took advantage of Wall Street basically despising this company. We didn't need to find great action. Well, nevertheless, at the point it was at 130, and now it's a little over 220. So we're fine, and it's still a fair. I think it's still a decent value. That's
And give us a sense then for what the process was. From how you generated the idea to what was really the key to the analysis and then position sizing. Just give us a sense by way of this example,
sure.
How you sort of applied your process to this situation. And if you don't mind, just give us the name of the company so that we have a sense of what it is.
Sure, and me naming the company, we basically have a full position now, so we're not buying it every so often. We do sell it when new ideas come up because it is an overweight position. In 2011 and 2012, it was our largest position. 2013 year end, it was our second largest, and right now it's our third largest. And unless new ideas come up, it probably will stay that way, without guarantees, of course, for full disclosure. The name of the company is National Western Life Insurance. The symbol is NWLI. I came across it as someone I know who's an investment advisor mentioned it to me, and I took a look at it, a hard look, and really studied it and said, wow, this is very interesting. Especially what I liked about them is during the financial crisis, as many insurance companies were downgraded by AM Best, this company was upgraded because of their financial strength. I really liked that. And it just seems that the reason for the price decline at that time was just pure fear everywhere. So we bought a small position, kept studying it. I would speak to the CFO, really studied the company and really went back and looked at all financials as far as I could go for many years and developed a thesis there. As I became more comfortable with it, we just kept accumulating it. Because it's a small cap company, it's very hard to accumulate because only a few hundred shares will drive up the price. And I got to know the company very well. I very much enjoyed the fact that they limited their dividend to build up their business. What better way than build up financial strength? We did urge the company to buy back shares when they were selling at 30, 40 cents at historical cost on the dollar. But they refuse to do so for whatever reason they have. I don't necessarily agree with the reasoning, but that's the one downside I saw in that. And the Moody's, father and son, have been running that business for 30, 40 years. The business has been around since 1956. And they're just a plain meat and potatoes life insurance and annuity company, known for their conservative policies and so forth.
And now, give us a sense how you analyze this company. For a lot of investors, life insurance companies are not necessarily the easiest type of business to evaluate, to understand. Some people may refer to these types of businesses as black boxes. How do you really know what the assumptions are and so on? So give us a sense of, once you got interested, in the analysis stage, how do you go about analyzing a business like that? Sure.
And life insurance, like you say, or any insurance company, is a black box. There's nothing you could do about that. Berkshire Hathaway, in a sense, is a black box. We don't know the operations of Geico, of General Re, any of their private companies. We can't really develop anything other than a trust of Buffett and so forth. So I did the same thing here. It's so much of a concern of mine, the black box of any company, more so with a life insurance company. How do I try to alleviate that concern? They've been around since 1956. They've been successful, typically. When they've lacked success or messed up, they've talked about it in their annual report, and they live up to it. I always like that. They seem to have been conservative in their accounting, in their actuarial assumptions and so forth. So you can't eliminate the black box. That's just not possible. But we have a nice margin of safety, I think, when you have the assets of the company at such a discount to its either historical, to the balance sheet or to fair value. So that gives a little bit of margin of safety. But like any investment, could be incorrect. There could be some type of fraud involved. There could be some terrible actuarial assumptions that they're under reserving. But once again, being around since 1956, almost 60 years, it gives a little bit of comfort there. But the black box you just can't get around it. And but that's not. And when I look at National Western Life, a very simple company. They sell insurance. They buy higher rated bonds to fit what they think is the life of that policy, and their duration of their portfolio is quite low, 5 to 7 years. And the same thing with annuities. Although now they, it's an interesting situation now with interest rates being so low and annuities. There could be a loss as each year if they're paying out more than they're earning. People are living longer, so that or there could be any type of event that could mess up the thesis. But then once again, we go to their longevity and just do our best. And they're an interesting group because we try to speak to management, and they don't speak. They put out the reports, and that's it. So it's an interesting situation.
And when you say conservative accounting and just you detected conservatism in this company, give us a sense of how you made that judgment. What did you analyze in the statements that gave you this comfort that you can say, okay, these guys are conservative?
Once again, the most important is being around since 1956 and seeing that their accruals were always in line with their estimates. No surprises along the way. Many years ago, I think in the 70s, they went into some bad businesses, and that got cured. When you look at their investment portfolio, was typically AA, AAA bonds. So there's a sense of conservatism there. As interest rates have gone down over the years, values of bonds have gone up. So when you see most insurance companies marking to market and showing their balance sheet at fair value, you don't have that here. You have them still, they choose to report their investments at historical cost. So when you look at their balance sheet, and you say, well, they're selling at 50 cents of net assets, and compare that to other insurance companies. One has to look at the other insurance companies. Well, what if you mark this to market? Are they still at 50% discount to net assets? Well, no, then it becomes maybe a 25% discount to net assets. Now, vice versa, if interest rates continue to rise, bonds will lose value, and other insurance companies their balance sheet will take a haircut because of that. But here, hopefully not, because they're still showing a historical cost. They do in their footnotes show the value of, the true value, so you can work out those numbers.
And what would you say more generally with insurance businesses, life insurance? How should an investor think through the interest rate impact? You mentioned the low interest rate environment, and how does that figure into your thinking about a business like this? What are the scenarios? If interest rates rise, what happens to the assets, liabilities of a company like this?
Sure. A company like this, if interest rates rise, it depends how they rise. If they rise slowly, it's typically going to be a benefit to, let's say, a National Western Life insurance company, primarily because their net interest, their margin will increase. They're pure interest rate sensitive. So now with interest rates so low and their payout not much different than that. There's not much margin in there. So their return on equity on each policy they sell is not what they hope it would be. If interest rates rise slowly, that will be a benefit. If interest rates escalated to let's say the 5-year went to 6 or 7% quickly, that might be difficult, because then you might have a so-called run on the banks, where policyholders would cash in their policies and look for a higher return. Once again, they're somewhat sheltered from that because they have a lot of cushion in the built-up gains compared to the balance sheet. So in summary, National Western Life, a slowly rising interest rates would be net positive for them as they took advantage of the margin. And then that's basically it for that.
What about just more generally, when you think about the level of interest rates? It seems that we're at historical lows, certainly in the developed world, and there are various opinions out there. Some people are concerned about the rise in interest rates. Others think that interest rates can continue to be this low for a long period of time. How do you, as a value investor, think about a macro factor like that? Does that even come into account in your investment process, or how do you get comfortable with this on a micro level with different types of businesses?
Sure. I think it was Alan Greenspan who said years back, one cannot predict interest rates. And I that's always sat with me. My gut feeling, I think interest rates at some point will rise when the economies get better. And we're certainly keeping a keen eye on that. The difficulty for me investing over the last few years is, historically, we've had balanced portfolios, fixed income as well as common stocks. We've really eliminated fixed income from our portfolios because of the yield. We've tried to substitute that fixed income with the last 2 years. We've accumulated quite a bit of utility companies that are regulated, pay what we think is a sustainable dividend, 4% to 5%. Highly rated by the credit agencies and so forth. So we've somewhat balanced our portfolios with those, yet you can't compare utilities to fixed income or quality fixed income. Who's to say if a utility now has a price earnings ratio of 12, who's to say it won't become 6? Well, if it becomes 6, there's a 50% haircut on the security. Now, in the mid 70s, as interest rates escalated in the U.S. and probably worldwide, all investments took a hit, but utilities as well. And utilities had a price earnings ratio of 4, of 6 was not uncommon. So it's an interesting scenario. So we're we look at interest rates. We realize they could go up. We don't know if they'll go up. So we try to balance with value, with quality companies and so forth. There's a very interesting, if I could divert a little bit, there's a very interesting situation I looked at recently. And I've always known about the rule of 72. Most of the listeners, I'm sure, heard of that. 72 would be the numerator. The interest rate would be the denominator, and whatever that difference is how long it will take to double in years. Well, historically, the 3-month Treasury from, let's say, 1970 to 2000 paid around 6%. So if you take 72 as a numerator, rule of 72, divided by 6, it takes 12 years to double. Well, now the 3-month Treasury is near zero, and rather than 12 years to double, it's over 1,300 years. That's a big amount. So part of me says, and I was yesterday on a go out jogging with a friend of mine who's a university professor, and we were talking about utilities, and I said it's very interesting because if they dropped to a PE now of cut in half, the interest rate would, he said, well, that's okay. The interest rate would escalate. I'm like, sure. So the interest rate might go to 10%. But because of the current interest rate environment, I have a feeling if that were to occur, the interest rate would drop to a more normalized 5%. If the 3-month Treasury went to 4%, 5%, 6%, then a utility certainly can pay 7 or 8% and might adjust for that PE contraction. That's the way we look at things as well. Certainly look, if interest rates are to rise, hopefully it's because the economy is getting better and not because there's a loss of faith in the credit of let's say, the USA, which could cause a rise in interest rates. So it's something I'm in tune to. We try to adjust our portfolios for that, but just something I think about. We try not to get too macro on our investments, but certainly are very, very aware of the world, and but look a lot at the world as a lot of it is noise. Political events, things are always happening in the world, and like Warren Buffett said, it was a great time to invest when he wrote his article in the New York Times. If you wait for the robins in the spring to show, it's going to be too late, and we're very very in touch with that.
And what about as an investor, how do you then think about this issue of reaching for yield? So of course everybody's facing the same environment, and you described how you're substituting your historically your fixed income portion of the portfolio to now you're looking at equities, utility companies, and so are many other investors, which leads to multiples perhaps expanding, and even with utilities, and you think you're getting something, but then the risk is there because other people are doing the same thing. So give us a sense of what are perhaps some other ways that you think about resolving this issue of needing income in your portfolio but not getting it in the fixed income world, but still thinking contrarian, thinking independently.
Sure. I try to think that we're not yield reachers. We do our best to keep quality in the portfolio. We don't need an income in the portfolio by any means. Right now, our dividend yield our average dividend yield is near 3% on our total portfolio, but that's not a requirement by any means. I think that utilities currently, at least specific utilities, are a contrarian investment. They've been in the Barron's Roundtable recently, and not the Roundtable, but the Barron's issue of what most investment advisors like. It was almost unanimous that utilities were frowned upon. They are not liked. Many are concerned, well, higher interest rates will reduce the value of interest rate sensitive investments, which often is true. But I think that there are many utilities that have a sustainable earnings flow that are value investments. Utilities over the last 3 or 4 years have not done well. I think part of the reason is twofold. One, the utilities are regulated, and much of the price they're allowed to charge is based on the price of natural gas. Natural gas went, I believe it was $13 a unit, went to about $2 a unit, and now it's touching $5, still well below its highs. So utility profits are down, in my opinion, because natural gas prices are down. If they were to rise, and they're already starting to rise, I think you'll see more profits in utility companies, as well as when the economy takes hold, employment starts to increase, businesses start to invest again, utilities will generate just through more usage. I think they'll generate greater profits. You've also had, especially on the East Coast in the United States, terrible hurricane seasons that really really hurt the utility or hurt the whole geography. I was reading yesterday. New Jersey had 98% outages during the last hurricane. Was that Irene? I think it was Irene. No, Sandy. I'm sorry, Sandy. Actually, I don't recall. But that's a lot of outages. So they had to spend billions of dollars in CapEx to make sure that they produce electricity for the users. But they're still in the process of trying to get the regulators to repay them and earn a return on equity on those. And I think those will start coming through over the next months, years, et cetera. So I think not reaching for yield, but looking at a utility, really being able to project their revenue, earnings flow, cash flow, CapEx, and so forth, and paying a historically fair price based on typically price to book, price to earnings ratio, dividend payout ratio. I think that could be, if analyzed properly, a decent alternative without so-called yield reaching. But by no means can one substitute a U.S. Treasury and their safety with one of a utility. One, a U.S. Treasury, a 3-month Treasury, you're saying, I'm okay, no interest received, but my principal is always intact. You can't say the same for a utility. And investors must know that before they do any type of investing.
What would you say is the biggest mistake that investors make?
I think the biggest mistake investors make is probably letting emotions get in the way of their investments, such as during the financial crisis. Well, that was an unusual time because fear was rampant. But to sell into that, probably a big mistake. And I think that's why mutual funds historically show that they underperform the averages. I think a lot of it's based on inflows and outflows of what investors are doing. Buying euphoria, selling in pain. And I forget who said it, but value investing is investing with sweaty palms. I mean, it's a concerning process. Especially you're buying what as a contrarian, you're buying what the world doesn't like, or you're selling what the world's in love with. I always try to look at the biggest mistakes I make, not necessarily investors. Selling too soon. Selling too soon is a big mistake. Sometimes buying a company and not seeing the big picture, but seeing a mistake afterwards. I guess the important thing, though, is once I see a mistake in our research, and it happens on occasion, and do our best to remedy that mistake, maybe by sell it and so forth. Or just understand we're human, we're going to make mistakes. A baseball player, we've often said a baseball player, if he bats 300 over his career, he's going to the Hall of Fame. Yet he's gotten out 70% of the time. So that's, mistakes are human, and that's unavoidable. Try to do our best to learn by our mistakes and to treat it as a sunk cost.
How do you mentioned the psychology of investing and the emotions, keeping them in check. Give us a sense how you deal with that. In an environment like '09, when everybody else is having that fear and that's paralyzing them, what do you do differently? How do you sort of stay disciplined, stay rational, and keep your emotions in check?
It was a very difficult period, '09. We went through a crisis and so forth. So keeping the emotions in check were tough. I'd get up in the morning, brush my teeth, and say, you look at yourself and say, well, it was a very difficult time, but and then I guess my most important thesis for myself at that time period is I kept looking in history and saying, was there ever a time when there was mass pain that an investment did not turn out? Was it ever not a good time to invest when the world was looking like it was going to end? And I couldn't find any. So I was, said I would just try to, I would take away the emotion and just look at the fundamentals and avoid the pain and so forth. But at the same token, look, if the world fell apart permanently, what good was money in the bank anyway? So it's a tough thing to answer. But I guess the basic thing is to keep emotions out of investing. Just look at it like a textbook, but make sure you're not fooling yourself and really look at the whole forest. I'm always trying to pierce holes in my research, always. I ask other people to pierce holes because it's the only way you'll learn. People get scared to, I don't want to insult you. No, feel free, please, point something out. I'm very open in that.
What are perhaps one or two recent books that you've read that have aided you in sort of improving your investment process? And you mentioned the continuous learning that's really so important for any investor. Are there any recent books that you can share with us? Any lessons learned?
Sure, and very often I'll read books quite a few times, and in my library at work, I always write on my on the book when I read it and I gave it a rating. So books like One Up on Wall Street or Intelligent Investor, Security Analysis, all of the editions on all of those books, very valuable. And I'm an avid reader. I read a few books a week. They all seem to run together at times. I think as I continue to read and learn, I just always go back to the basics. Go back to the Buffett letters, the Benjamin Graham's, the Philip Fisher's. We were talking earlier. I was very surprised that Jim Cramer's new book, Get Rich Carefully. I thought I'd have no interest in reading it, and frankly, it wasn't such a bad value investing book. He's bringing a lot of long-term quality companies and so forth, and it was very interesting, very eye-opening for me to read, as I was expecting something totally different. Yeah.
Is there any piece of advice you can give to investors who haven't been around as long as you have, and can share with us just what can we do on a practical day-to-day basis to get better at our investment process and applying it?
Sure. In investing, you have to be able to understand financial statements. Do some type of financial statement analysis. And you have to recognize whether you are competent or not in it. Once you become competent at that, if you're going to do it yourself investing, do your own investing, I think you just have to continually read, learn, study history. Like Munger says, you don't need to read about the all the greats of today. There's plenty of people who have died that are great to study, such as Benjamin Franklin, which I've read quite a few of his books, as well as a biography written by him. Abraham Lincoln, I immersed myself and submerged myself in books by him. So fascinating. What a ordinary man, and to just keep reading and learning his principles. And his presidency was one of the most, I don't think it was ever a more adverse situation for a president. So I think continual learning about yourself, learning about investments, and really keeping an open eye to the world and filtering away the noise. I remember a client saying years back, well, maybe we shouldn't invest yet because look what's going on in the Middle East. It's in turmoil. And I was thinking, I'm like, in 2,000 years, has the Middle East not been in turmoil? It's just it seems like the norm. You can't invest like that. You're always going to have something bad happening somewhere, but you have to, keep your eye open, filter out the noise, and move forward.
Well, with that, Ronald, I want to thank you so much for your insights into investing.
And thank you for having me. It's been a pleasure.